name's Tami, and I opened up BayWest Mortgage April 1st, 2003 in Broc. So this year we're celebrating 20 years, which is a big, big feat to be something to be proud of when I'm talking about mortgage lending and surviving, especially after the crash that we kind of experienced in 2005, 6, and all that. The reason why that crash happened is you had unethical lenders that were out there, and in this business, if you have unethical practices, don't have any integrity, you will fail. You know, that is something that I have always been very proud about. Is it's always ethics, integrity, and honesty. I worked with Mary since day one of when I went back to work for Family Security Bank in 1997. I moved to Brookings in 1991, so I've actually lived in Oregon longer than I was born and raised in California. So I think I can call myself a Kentucky Oregonian at any rate. So that's a little bit of background for me. I started a mortgage company when I was 17 years old answering phones. So mortgage lending is the only thing I know how to do. When I started out answering phones, I worked my way up to what they call the lock-in coordinator, where you set interest rates for a particular person. This is when we also typed our documents. So we're talking, it took a week to get a credit report. Now it's right there in 30 seconds. So another thing about the industry, in any industry, is it's adapt or fail. So when you're talking technology, you ride along with it. So I moved to Brookings in 91, took about 7 years off to be home with my little ones that are now 32 and 28. 32 one hurts. Am I still 32? Shoot. At any rate, so went back to work for Family Security Bank and worked for them until 2003 when I went out on my own and bought them Security Bank holding company in 2002. So it was just time for me to kind of venture out on my own and see if I could do it, and I like to boast the fact that I've done it. It's been 20 years and I'm very, very proud of what I've accomplished. So that's a little bit about me. And when we talk about the mortgage world, there's a big, big thing that people don't know. What is the mortgage broker as opposed to the mortgage banker or your bank? Any big suggestions? Mary, you don't count.
Okay.
Anybody have just a shot in the dark?
Becky, you don't count either.
You don't count either. So, okay, so here, I'll just put it out.
I was going to give it a try.
Go ahead.
So the banker is the originator. The broker is the servicer.
Yeah. That's a hard good shot. Yeah. So as a mortgage broker, I'm the broker. I'm approved to do business with multiple lenders. So there's an approval process that we have to go through, financials and all that sort of thing. So as the broker, we facilitate the transaction. So we originate it, facilitate it all the way through until the closing process. The documents close in the lender that we set that particular borrower up with. So it closes in their name, the lender services or chooses to sell the servicing, which is very common in the mortgage world. And the broker is compensated when the transaction closes. So much like a real estate broker, real estate principal broker, or real estate agent, realtor, we're only compensated if the transaction closes. If you work usually if you're a loan officer for a bank or as a mortgage banking institution, you're paid a paycheck and then you're compensated based upon production quarterly. So that's not how it works in the broker's world. Not paid if it doesn't close. So that's one of the biggest things. The other thing is we're allowed so many options because we're not one particular lender. So you go to your bank, you think you're going to get preferential treatment because you've banked with them for so many years. For instance, I think he and I were talking earlier, you've got money in the bank, you think that that's going to be some stability and some consideration that they're going to give you. When it comes to a mortgage loan, Fannie Mae, Freddie Mac are your government or your GSE agencies, so they're backed up by the government, but they're not the government agencies, so in other words, Treasury's involved there, but Fannie and Freddie are independent. Then you've got FHA, VA, and jumbo sectors. So when we're talking about mortgage lending, if you're getting your mortgage from your bank, they've got to follow Fannie Mae, Freddie Mac, FHA, VA. They've got to follow those guidelines. So where's your preferential treatment for being a customer of yours? Not usually any benefit at all. As a mortgage broker, having all these arrays of sources, we're not hindered by one particular lender with one particular rate, one particular box you've got to fit into. Oftentimes with a bank, they set what are called overlays. So here we've got, we'll just call them the agencies. We've got the agencies overlay right here. Okay, we want a credit score of this, we want a down payment of this, and we want the property type to be that. You go to your bank, that's what they offer, plus, okay? We can do a credit score to 580, but you know what, that's too risky for us being a financial institution, a bank, or a credit union. We're gonna put that threshold. We want you to have a 680 credit score or better. Broker comes into play, we can go down to 580. So there's the options that the broker has. Interest rates, closing costs, the other option. When you go to your bank, that's all that they can offer, is that day's rate, that day's closing costs. They have a little bit of wiggle room, not a whole lot. So competition is always good for the consumer, but keep in mind that your bank is 9 times out of 10 a little bit more than what you can get on the mortgage side. Now, what's the difference of a mortgage banker as opposed to a mortgage broker? A mortgage banker specializes in mortgage lending. That's what they do. They originate, facilitate, and close mortgage loans. But they're also a mortgage banker, so they're one particular entity that's actually underwriting to, now Wells Fargo's got out of correspondent lending, but they're underwriting to Wells Fargo or Bank of America or Chase. Their guidelines, because when that mortgage banker sells that, or excuse me, closes that mortgage, they immediately sell it to that correspondent lender that they're approved to do business with. So they're hindered by that rate, that guideline for that particular lender that they're choosing. So the broker, especially right now where we're experiencing tighter inventory, tighter qualifying, that's why the broker is number one, because of the options that are available. One of the misconceptions that's out there as well is, do you pay for the broker services? About 3 years ago, actually about 5 years ago, we went into some major regulations that tightened the mortgage field, which needed to happen. You know, part of the housing crisis back in 2005 and 6 was you just needed a pulse to get a loan. Literally, you walk in. They had a program called Fast and Easy. You had the credit score of 700. Didn't matter. You signed that you're admitting that you make $10,000 a month as a waitress. Okay, that's what the problem is. Subprime lending. You could get a loan 100% financing. You had a 520 credit score. You had a 80% first, 20% second, 100% financing. You have bad credit. You have no money in the bank. Guess what ended up happening? You lost your home, because you couldn't afford it to begin with. So, I forgot what I was going with this. So anyway, there's a lot of changes that happen as far as a broker can be compensated, because a mortgage broker, there was not just the broker, but in the mortgage world, a lot of people were taken advantage of. Before all the regulations changed, a broker could be, a loan officer I should say, can be compensated with the interest rate structure as well as charging a fee. So for instance, when I worked at the bank, we would charge, let's say at the time it was 8%, and we're going to charge you 1 point. But yet on the back end, we're also making 2 points on that interest rate. So really, you as the consumer are paying more, because that back end was set at, let's say, 3%. Well, if that back end was only set at 2%, maybe you could get 7.5%. So those things kind of changed, which needed to happen. Some loan officers were banking 4% on a $400,000 loan, and that's what they were being compensated. But you as the consumer were paying for that.
So you were going with, how are we compensated?
Right, so as we're compensated now as a broker, we are compensated one of 2 ways. One, you can pay us directly, which is a great feature for us to be able to compete. If we're very, very far off, which is rare, then we can lower what our compensation normally is that we set with the lender. We can lower that, have you pay us, and then the lender gives you a credit towards what you're paying us. So anyway, it's oftentimes the same. It's a no point loan. If let's say we're competing, let's say I'm competing with Broc, they've got a 5.5% rate at 1%. Shoot, I'm at 5.5% at 1.5% fee. Well, for me to be able to compete to get that down below 1% to Broc, I'm going to say, okay, I'm going to charge you the 1.5% fee. However, the lender is crediting you that 1.5%. So endingly, it becomes a zero to you, but I was able to compete and get you the better interest rate by lowering our compensation. So that's one way. The more popular way is the lender pays us. Each quarter we set what our compensation is. And because BayWest is just Broc and Tami, husband and wife, by the way, we have very little overhead. So we don't have to compensate ourselves a fortune to be able to compete with the banks. As a matter of fact, the benefit is it's just the two of us. So we don't have to make as much. Therefore, our rates and our closing costs are substantially lower in 9 times out of 10 the case. So our compensation that we set with our lender is anywhere between 1 3/4 and 2.25%. We have different lenders for different programs. So in other words, let's say we've got a self-employed borrower, doesn't fit the box of the agency, so we've got to step out to this box. Well, this box takes a lot more time to process, so we set our compensation a little bit more than we do for the standard. Which, you know, there's kind of one of those things that's really frustrating to me is you've got industries where somebody could be compensated, and this goes for realtors as well. You're compensated for your time that you put forth in something, but at the end, something happens, and for instance, in the loan process, you know what, I changed my mind. You work that transaction all the way to the end, got it to closing, they sit down, you know what, the house isn't working out for me, we decided we want to go this way, and then they're done. We don't get compensated for all that time. Whereas if you're an attorney or in another industry, you're allowed to be compensated for your time. We're not compensated, and this is the same thing with loan officers and banks. Cannot be compensated to produce pre-approval letters. That's a big deal because sometimes you get some people that are out of town, they can't reach their normal banker that they like to do business with, or they talked to them before, got everything arranged, need to have the pre-approval letter to go with the offer. Okay, you can't get that now. Well, I'm just going to go down the street and I'll get one from them. Keep in mind that it takes a couple of hours. We generate that pre-approval letter, not knowing that they're really going to go somewhere else. Shoot. But that's the nature of the business. It's a service that we provide. Don't like to do it unless we're going to get the transaction in the end, but guess what? They remember that we're there. And that's another reason why being 20 years in a smaller community and standing is, there are a lot of things that we do in the background. We do a lot of stuff for the realtors and try to be part of the community. And huge, huge thanks to everybody that's supported me over the years, because it's not easy to be a 5-foot little woman in a big man's world. I'm telling you that. So, at any rate, so do you guys have any questions for me as far as what's going on in the economy and mortgage?
Yeah, what's
rates
going
and all
on?
that?
What's the future going to hold?
So, that's a good question. I actually think it's going to be very positive. You know, we've kind of got rid of all that negativity that just hit fast. You know, inflation, the Fed's acted too late. And now, okay, we've got 3/4 hit to prime, 3/4 hit to prime, another 3/4 hit to prime. What does that do to mortgage rates? Boom, boom, boom. We thought it was going to slow down. We knew it was going to slow down. It came to a screeching halt on the mortgage side. Literally came to a screeching halt. Because when you listen to the media, they're out there telling you, oh my gosh, did you see that interest rates are so high right now? My gosh, you can't get a mortgage under 6%. 1988, true story, bought my first house on a VA loan. I wasn't a veteran. It was $88,000 and it was a 10.5% interest rate, and that was a deal because I worked for a mortgage company.
My first interest rate was 18%.
And
Gotta make
you know,
6 look good.
Yeah, 6 looks great.
in 97, when I went back to work at Family Security, we were around 8.5, sometimes 9%. Okay, we're just used to hearing 2s and 3s.
Yes.
And you're not going to hear those 2s and 3s. And if you do, that means we're in trouble again. And we don't want those things. Of course, we love to borrow against that. Oh, sorry. Of course, we love to borrow at those rates, but that's not going to happen. That means our economy or something is very, very bad. So in the case of 2023, Come the end of the year, I think that we're going to kind of around 5.25%, around those figures for a 30-year fixed rate mortgage. Where are we at right now? Conventional mortgages, we're around low 6s. Government loans, FHA, VA, we're around 5.75, so high 5s. Is that really high? No, it's not. And so it's a mindset change. And now that the media hit us really hard, the last 4 months, that's starting to change. The mindset's changing. It's like, okay, this is the new normal. People are understanding that this isn't just a quick blip up. This is where our natural correction happens. And this is where we're at. We're inflated now, like I said, come the end of the year, I think we're going to wind up in the 5s. So what does that do for people that want to buy now or want to refinance now? It makes sense for somebody to want to refinance at the 5% rate, because what if you've got a lot of credit card debt that's now facing 23%? And you've got $25,000 out there. A lot of self-employed borrowers that started their business 2 years ago thinking that things were going to shake out and be able to pay off their personal debt that they put forth. Didn't really happen that way. Maybe we look at refinancing your house. Yes, you've got 4.5% right now. You might be going to 5.5% right now, but guess what? You're not paying 29% on $25,000. Or maybe you do a home equity loan to get you by. For, home equity loans are running anywhere from prime +3 at your bank. We've got a program that's higher than that, but it's a 5-day home equity loan. Literally, it's 5 days. You're either approved or you're not. You don't get to talk to somebody about it. There's no appraisal that's done. It's an appraisal valuation tool. So let's say somebody, for instance, I've got a borrower, they own the home free and clear, it's $600,000, they want a $100,000 loan to go buy something in Florence. Okay, 5 days, funded, done, over with. They're gonna list their house for sale and pay that $100,000 off in a very short period of time, within a year. So those 5-day HELOCs were really great. You're gonna pay for it. You're talking prime +5, so you're gonna be getting 11% up. But short term, it makes sense. So refinancing, not always a no. There's sometimes a reason for it. If it doesn't make sense, I'm going to tell you it doesn't make sense. But there's got to be a different way for you to do this. That's the other benefit of what Broc and I do. If it doesn't make sense, we like to sleep at night too. So I'm not going to stick you into something. If you can get a program or a rate at Rogue or Umpqua and I can't compete, I'm going to tell you I can't compete. I'm not going to charge you more. I'm going to tell you your experience is going to be a little bit better, but I'm not going to charge you more because, again, we like to sleep at night. So yes, as far as the economy goes, mortgage rates will settle, and they have pretty much. Prime is not how mortgage rates are set. Mortgage rates change each day based upon economic data. So look at your bond market. 10-year treasury. When that treasury is down and people are putting their money into stocks, guess what that does for mortgage rates? It's up just a little bit. Stock market's down, bond market's improving, mortgage rates go down a little bit. So it's not just prime. So when prime gets increased, chances are your mortgage rates already happened because we've been reacting to what the feds have said, the month before, or little things that are out there in the economy. We're already reacting. So when prime goes up, we have a tendency to go down. So if you are ever in search of a mortgage, competition is good for the consumer. Call that exact same day with that to get the exact same rate quote, because the next day it could be higher, the next day it could be lower.
So do you lend the money out yourself?
No, as a broker, we again are approved with multiple lending sources, so we facilitate it. Then we get it all the way to the closing process. They draw the closing documents. It closes in their name, so they close and fund it. We just facilitate it all the way through. So I work with you one-on-one, all the way through the transaction, all the way to closing. They sign at the title company. The loan closes. Even after, we're in contact with you because there is a transition just like anybody else. How do I set up my auto pay? That sort of thing.
So why do they need a mortgage banker and you?
So you mean a mortgage banker, or you mean a lender or a bank as opposed to me? Competition, rates, fees.
But you still have to go
expertise.
through a bank, so you still have to have a loan officer at the bank, right?
No, you just deal with me.
The difference is a bank is retail. We work directly with wholesale lenders on a wholesale level that rely on us as the broker.
You work directly with.
And you work with us as your loan officer. We also do all the processing because we're a small place. We do it all from start to finish, and the lender then funds your loan. So the wholesale lender. So that's how the broker works.
So your loan is originated through BayWest Mortgage. Hi, I'm Tami with BayWest Mortgage. I sign all your stuff all the way through. I'm the one who counsels you, walks you through your closing costs, walks you through all your documents, that you understand what your loan program is. It's a 30-year fix. Okay, no, it's an adjustable rate mortgage. So at the end of, say, 5 years, this is what's going to happen with your loan. When you go to closing, okay, here's your documents, take a look at everything, everything matches up, you sign, you close in ABC Mortgage 101's name. So ABC 101 Mortgage is now your lender.
That's what I told him.
Oftentimes, a lot of, before, a lot of banks and mortgage bankers retain a lot of their servicing. So servicing is when your mortgage loan closes, who are you making your payments to? That's who's servicing your mortgage. So a lot of times, servicers sell off their servicing. Why do they do that? They sell it to another bank. Why do they do that? It opens up funding for other transactions. Mortgage banker, they have a warehouse line. So a mortgage banker, it would close in that mortgage banker's name. So let's hypothetically say that BayWest Mortgage is a mortgage banker, not a mortgage broker. You're going to close, I'm going to close your loan in BayWest Mortgage's name. I'm going to turn around and sell that servicing off to ABC Mortgage. You're going to get a notice in the mail that within 60 days, your first payment's going to be due to ABC Mortgage. So
Boy, does that confuse people too.
and it does, it really does. It happens, Rogue and Umpqua, they sell off their servicing, and there's a pool of how it works.
They don't always though.
They don't always. Again, it's a pool, so there's a module kind of thing that works, and so depending on interest rates and structures and credit scores and so forth, it goes into this pool. And let's say in 5 years, you know what, these ones have paid down, we're going to take this pool and we're going to sell that. It's not always immediate. Sometimes it takes 3 years. Again, it depends on where you fall on that.
So kind of the way I like to think of it, I haven't been doing it as long as Tami has, so I have a different way of looking at it, is the mortgage banker or smaller banks, they can fund the loan, but they can't keep the loan because they want to fund more loans. They've got to sell the loans to keep their pool of money to be able to facilitate more loans to continue to sell. We simply facilitate.
When you're a bank, you have so many pools. So we allow, we need to have this much in deposits, we need to have this much in consumer loans as far as home equity loans and car loans, and we need to have this much that we have in mortgage loans. We've got too much over here, we've got to sell that off. It's always a balance. That's why you have a board of directors in banks.
At or near their peak, given recent encouraging news around inflation, corresponding drop in the United States Treasury yields that help set mortgage rates, a sustained drop could push mortgage rates down into the low fives and sustain that for 2023. The Mortgage Bankers Association says long-term rates have already peaked, and we expect that the 30-year mortgage rates will end this year at 5.2. These are all very good signs. So when you hear things on TV or wherever you might hear them that, oh my God, rates are going to continue to go up, we are getting to a stabilization point. Here's the National Association of Realtors saying if inflation continues to slow down, and that is what we expect, mortgage rates will stabilize around 6. So again, good news coming out. We have to weather maybe midway through this year, but by the end of this year, I think we're going to see stabilization, not back down to 3s, but 5s and 6s are okay.
Well, thank you both.